Welcome back to the CNBC-TV18 Budget Verdict 2025. And for our next powerful discussion in the next panel, please welcome on stage, and we have some of them on stage already, Mr. M. Nagaraju, Secretary, Department of Financial Services. Ladies and gentlemen, big round of applause, please. Mr. Ajay Seth, Secretary, Department of Economic Affairs. Mr. Ravi Agarwal, Chairperson, Central Board of Direct Taxes, and Sanjay Kumar Agarwal, Chairperson, Central Board of Indirect Taxes. Over to you, Shereen, for this panel.
Gentlemen, a big round of applause for the secretaries from North Block who join us here. And they've been very kind. It's been a very busy month for them, not just a busy week, a very busy month for them. So we appreciate you taking time out here to join us and answer questions that are coming in live on our YouTube page, on our social media handles, and of course here from our live audience. Economic Affairs Secretary, if I may start by asking you, sir, as we've been talking about it, this budget has really tried to address the 3 C's: consumption, Capex, and consolidation, and it's done well on each of those fronts. It seems to have prioritized consumption at this point in time with the personal income tax cuts. If I could ask you about the concern perhaps that there has emanated on Capex, and the question coming in, the Capex to GDP has come down from 3.4% of GDP in the BE of FY25 to 3.1% of GDP in BE of FY26. Is this an admission of the execution limits of the government or the limits to the absorptive capacity of the economy? And I'll link this back to the point that was made by the former Finance Secretary here on the budget verdict last year, when he also said that there has to be a limit to how much you can expect the government to do as far as Capex is concerned, and perhaps at this 10-11 lakh crore rupees is the peak that the government can do on Capex. So if you can explain the rationale, the thinking, and the roadmap from here on.
Thanks for this question. I'll draw your attention to July budget, wherein Finance Minister said that we have brought the Capex, public expenditure on Capex, to a very high level, and moving forward our endeavor would be to maintain it relative to GDP at that high level and expect a similar amount to come from the state governments and thereafter private sector to chip in. Where we are in that one, till about 5 years back we were 1.5% of the GDP. That used to be the Capex from union budget. Today it is 3% plus. But if we add what the grants Government of India provides to states for providing for their capital expenditure, prime example if you can say Jal Jeevan Mission, there's a huge amount of provision getting made there. The total provision is 15.5 lakh crore, which is 4.3% of the GDP. And please look at the number. Total fiscal deficit is 4.4%. Yeah. That means almost the entire borrowing of Government of India is going for capital expenditure. Since mid-70s, we never had a revenue surplus. So these are the limits of capital expenditure, what the government can do, union government can do. But even with reference to the revised estimates of this year, the increase, the total provision next year 15.5% is about 18% higher on an economy which will be growing at about 10% plus. So these are the limits, and by sure, it is not a reflection of implementation capacity, but the newer sectors have to be brought in. Newer sectors meaning urban infrastructure is a big sector, and this budget provides for additional 10,000 crore for them. Plus social sectors have to be brought in. Plus public-private partnership, where the push has to be given through the renewed effort on that part. Thank you.
On each of those issues, sir, and if I could, address something that you just spoke about, the Jal Jeevan Mission, for instance. The question is, grants for Capex to states include schemes, as you pointed out. It includes the NREGS, it includes the Jal Jeevan Mission, the PMAY, etc. A lot of it, which analysts believe is not technically Capex. Why would you then include this to look at like the Capex budget, is the question, sir.
See, there can be an issues around whether an asset, rural asset getting created out of employment generation scheme, whether that is a typical infrastructure or not, there can be a different opinion. But rural water supply will run into as large as 5 crore, 10 crore, 20 crore, even a 50 crore scheme. These are very much capital assets. So the only thing is, these are not the capital assets which will be on the balance sheet of Government of India.
Okay.
So even if we leave around that part, just come to that what the numbers are. Government of India is spending 3% plus of GDP, plus CPSUs is spending almost another 4.5 lakh crore, which will about 1.5% of GDP, is a substantial amount. The government system, union and central PSUs is spending close to about 19.5 lakh crores, which is 6% plus of GDP. So this is a significant number.
So there is no deviation on part of the government strategy to address growth via Capex. That policy objective, that policy intent is steadfast.
That is correct. And there where the balancing were to come in, that on one side consolidation is happening, as you said, a fine balance between consolidation, consumption and Capex. That is a fine balance this budget tries to do.
On consumption, sir, and I think, there is unequivocal and unambiguous appreciation for what the government has tried to do to try and stimulate consumption and stimulate demand. But the question is, when do you expect this to kick off? When do you believe we will start to see the real impact of the measures taken by the budget to kick off and provide that consumption boost?
Other measures in the budget, whether it is on a Capex or on reforms or several schemes, will always have a lag. But as far as consumption, the big tax relief, which is 0.3% of the GDP, 1 lakh crore, individuals get to know that from 1st April onwards, that is an extra money in their pocket. They may use it for saving, they can use it buy durables, they can buy it for another EMI, for a larger house, etc. So the impact starts immediately, the very start of the financial year, because that money is extra money is available for them to use it in a manner, or even taking the family out for a tourist site, and hopefully within India.
Hopefully within India, and those 50 tourist destinations that you're hoping to put in places to attract more tourism. But I come back and I asked you this question on budget day, sir, and I come back again to the estimates that you believe you're working with. Krishna, the former CA, said that he expects more than 2% addition to the GDP on account of the measures undertaken on the consumption side. Would you hazard a guess on that? I mean, is that something that is that a number that you're working with?
I have not attempted doing a modeling. This will be based on certain assumptions would be there.
Yes.
But I see that in terms of giving a boost to the economy, this is the fastest means available. And it helps the middle class having an extra income. They take their own decision in whichever manner. Even if somebody were to do the savings, it will remain with the bank or in the financial market, which will go on to the productive activities later on. So I see it as a very positive for the economy. Where the numbers are coming, normally we see it over a period of time. Any capital investment has a multiplier effect of 3, 4 or even 5 it can come in. What impact it will have, we will see that certainly in high level of consumption. To that extent, the plant and machinery of the private sector get utilized much faster. Or if it goes for the tourism, then hotel occupancy goes up. And to that extent, those owners of those plant and machinery get enthused to invest in the next round of capital investment into the economy.
Well, that certainly is the hope. Mr. Nagaraju, let me come to you, sir, and address the issue as far as MSMEs go, because that was something that the government and the finance minister spoke about in the speech. There was a question here specifically from one of our audience members on why the interest subvention for MSMEs, which was for a period of 5 years, has now been done away with. They believe that it ought to continue. Your take on that, as well as some of the other measures that were announced by the budget, the enhancement of the credit guarantee for SMEs, etc. Do you believe that this will provide the much needed support, the much needed stimulus and shouldering for the MSMEs, sir?
Yeah, see, the MSME sector is one of the highest priorities for the government of India due to several reasons. One is, of course, employment generation, and the other is contribution to the GDP and also to the exports markets. Now, this is where the highest potential exists in the country for creating additional employment. Now, if you look at the budget proposals that are proposed, there are several schemes to promote, incentivize, as well as give comfort for lending more to MSME sector. Now, the other scheme, apart from the MSME, there are several schemes for the MSME sector in this budget. The other thing we have revamped is Stand Up India. Earlier it used to be Stand Up India to promote first generation entrepreneurs among the women, SC, ST. That limit has now been extended, and we'll be looking at a large number of entrepreneurs, first generation entrepreneurs, which will be again micro or small enterprises in the MSME sector only. So the government intention is very clear that whatever is the central credit guarantee schemes are there, they are going to lend to the MSME sector. And then the second one, which is of course the partial credit enhancement facility that we have proposed, and the NAFID, of course that is for the corporate sector. If they are going to issue the bonds, there will be the credit rating will ensure that their credit rating is enhanced.
Okay, so the credit rating will be enhanced. Those are the measures for the MSMEs. But on the insurance FDI, sir, is there an expectation or an estimate of what that could mean potentially in terms of FDI inflow into the country? Are you aware of how many may be interested at this point in time? There are all kinds of numbers doing the rounds.
While I can't hazard the guess, let me give you the number. From 2000 to 2024, the total FDI flow into insurance sector is 82,000 crores. Now, 24 years, only 82,000. Whereas, the country of our size, dimension, and challenges and potential, I think we should have actually attracted huge amounts of insurance FDI. Now, there are issues related to that. Those issues are being now addressed in the budget proposals of the finance minister. One is, of course, FDI enhancement. Technically, a owner can own more than 51% and then he's a owner. It could be 51 or 70, 60, anything. Ownership-wise, there is no issue at all. But we want to give comfort that a foreign investor, if he bring in the FDI, he can hold up to 100%. That is a comfort we are giving. The second issue, which is interconnected, is the rules. Rules have some restrictive provisions which we follow. That rules we are going to review and simplify, ensure that the investor, the FDI owners have full flexibility in appointing the senior management personnel and also for repatriation of dividends if required. And of course, anyway, we have already mentioned in the budget speech and the condition that entire premium has to be invested within the country.
Yes.
That remains. So we expect there is a lot of enthusiasm during our consultations with the stakeholders. We see huge potential for FDI inflows.
How many companies, sir?
Many companies met, many companies have said, and we have to see ultimately when the bill is approved, notified, then ultimately the taste lies in the pudding, okay? But we have to see ultimately how many will come, how much it will come.
The pudding is being cooked, so to speak, at this point in time. But Mr. Seth, since we're talking about FDI, if I could ask you about the FDI harmonization, sir, and where we actually stand on that front, and what realistically we should expect now in terms of timelines.
Last budget, February budget, the interim budget, Finance Minister announced that we will be signing more FDIs, more BITs, and with the two countries, United UAE and Uzbekistan, those were signed. And the current model BIT template of 2014 had a legacy issue. We were suddenly seeing a spurt of litigations which we never thought BITs will be interpreted in a manner to get us over there. That's why a model BIT was brought in, and earlier BITs and BIPA were terminated. But the last 10 years we are seeing that a consistency of the policy, unidirectional, improving upon the policy, that gives us a lot of confidence that we can provide a better set of protection for foreign investors. So really the attempt is, and our conversation with those two countries as well as other jurisdictions, is what the investors are really looking for. So between the state interest and the investor interest, that's the one area to move forward. I will not like to judge into or say that what areas can be, but if you can cite just one example, model BIT says an entity-based protection, meaning one has to have an entity in India, registered in India to do so. Whereas investors are expecting an asset-based. Those who are coming through an FPI route should also be eligible for investor protection. That's one area we are actively looking for to get into, and there are several others.
Several others. Gokul, you wanted to make a point?
Thank you, sir. It's good. My name is Gokul from Deloitte. Glad to hear that the BITs are back on the negotiation table because investors have been asking for it. There was some amount of debate on whether tax as a subject will be included in the BITs or not. Is there been any sort of thinking on that topic?
The finance minister has said we'll make it more investor friendly and we will have a deep review. At this point of time, to get to say that what is on the drawing board would be rather premature. So allow the government to complete that exercise, but idea is complete it over next couple of months, maybe in about 2 quarters, and then come out with a model or model BIT which is suited for 2025 requirement. At the same time, there's a realization that the world has changed. There are so much of global uncertainty. We have to shift our game itself to attract more FDI.